This episode of Bulletproof Cash Flow is brought to you by Realty Dynamics. Learn how people like you can build substantial passive income while creating wealth for the long term through real estate investing. Visit rdyne.com. That's RDYNE.com.
A lot of the deals are deals that I'm going out there and I'm finding. I have a few different partners that I tend to work with. And so if I have a deal, a lot of times they're too big for me to, do on my own. A lot of the time I will bring in one or two of my trusted other companies that I work with, and we'll partner together on deals. And sometimes they might find an asset and call me up and bring me in. So I find that multifamily really is a team sport.
Working because you want to, not because you have to, is financial freedom. And we want to help you create that. Welcome to the Bulletproof Cash Flow Show. We're going to teach you how to achieve lifetime financial freedom through real estate investment. Your host is a multifamily syndicator and property developer. He's done deals reaching into the hundreds of millions of dollars. You'll hear from experts in all aspects of real estate investment, finance, development, and management. Everything you need is right here. This is the Bulletproof Cash Flow Show. And this is your host, Augustino Pintus.
Hey everyone, it's Augustino. A strategy many investors use to get in the real estate game is starting out as a passive investor on deals. Now, once the LP, the limited partner, is comfortable on jumping in on a deal, they'll then decide to jump in as a general partner on the GP side to work on the major elements of making a deal happen. Now, our next guest knows all about this. He has over 15 years of experience revitalizing and elevating communities through real estate investment and has invested in over 10,000 apartment units nationwide. He is a real estate investor, the author of the #1 best-selling book, Backstage Guide to Real Estate, and he's also a Tony Award winner for his work on several Broadway shows. Now today, he is focused on developing passive income streams that have enabled investors to write their own story and choose how they want to spend their time. Now, with all that, I'd like to welcome Matt Picheny to the show. Matt, buddy, thanks for coming on, man.
Hey, thanks. It's a pleasure. I'm really happy to be here.
Very, very good. Yeah, I'm happy to have you on. Now, guys, like what Matt has to say, you can reach him via his contact page at picheny.com. We'll include a link in the description. Okay, Matt, go ahead and tell listeners a little bit about your start. How'd you get started in your journey?
I moved to New York City in 1992 to pursue a career in theater. I did that professionally for about 5 years and started doing website development in the mid-90s and actually had an opportunity to start my own company. There was so much work coming on. This was during the dot-com heydays. 2001 came along and the dot-com bubble burst and my business just completely imploded. I mean, it was a major, major fail. And at that time, just as luck would have it, I got a phone call from my landlord who told me I had 90 days to get out of the apartment that I was living in. So I had to figure out how do I stay in New York? I wanted to stay in New York. I love living in New York City, but how do I stay in New York without a place to live, without a real job? I mean, the business had completely failed. I ended up getting a job actually at Showtime, the cable television channel. It was a client of mine. They offered me a position in-house. And instead of renting an apartment, I actually bought an apartment. Now, it wasn't where I wanted to live. It was way, way, way upper Manhattan in an area called Washington Heights. But I bought an apartment unit, and about a little over 2 years later, I ended up selling that apartment unit, and I saw that my value, my down payment, my initial investment in the property, more than quadruple in value. And so that was a huge eye-opening moment for me to see the value go up so quickly. I mean, I was making a very good salary at that time, but I mean, in that one real estate transaction, I made more than an entire year's worth of salary. So I was like, how do I do that again? How can I make that happen? And that's what really set me on the journey as a real estate investor.
Excellent. You know, it's funny. I often talk about appreciating markets and cash flow markets, and Cleveland is one of these cash flow markets. And by that, I mean you buy the asset, it just produces steady cash flow. There's no wild swings, no crazy leaps in terms of valuation that eventually end up hitting a ceiling and coming back down. New York is one of those places, on the other hand, New York and Los Angeles, places like that, they just keep going up. And it might take a little dip, but it'll still keep going up way, way, way faster. So do you find that a lot of folks, they'll invest in places like New York on a regular basis? Or, because it sounds to me like you sold off that unit. I don't know if you're still, I know you still live in New York right now, but did you end up buying another apartment there and do the same sort of thing again? Or did you figure out that it's probably not the thing for you to do?
Well, I needed a place to live. So the investments that I've made in New York have been primarily as primary residence, right? So that's gone very well for me, where the values have gone up, like you said. But, you know, there was a time after that place when I sold it, I ended up buying another apartment because I needed a place to live. And this time I bought it on the Upper West Side, which is where I wanted to live. I was very happy to be there. I did that in, I think it was 2005 or so. I saw the value go up quite a bit, but by 2008, it went way, way, way down. So, you know, I mean, the markets can be fickle to a certain extent. So, yeah, New York City does tend to go up and up, but if there's a large, downturn in real estate in general, it affects all the cities. So I tend to not invest in New York. I live in New York and I love New York, but for me and my real estate, I tend to invest more in the middle of the country and more in cash flow markets, like you're saying. You know, it's really nice when you have an asset that you've owned for some time and then you sell it. You can make some good money on that exit. But what's more important to me, excuse me, what's more important to me is my cash flow during the time that I'm holding the apartment. So like you had mentioned Cleveland as an example, you know, I think you can find it in many, many different markets, but the most important thing, I think, is cash flow, so that you can ride out those dips, because there's going to be ups and there's going to be downs in economies. We all know that, right? It moves in a cycle. What no one can predict reliably is when it's going to go up or when it's going to go down, or how far up or down, or for how long. But if you have cash flow that where you can maintain the property, you never have to sell it because you're in a bind, but you can wait for the right opportunities to make an exit. That's the best of everything.
Yeah. I mean, there's guys that do focus specifically on the New York market, those appreciating markets. I just don't. For me, it's not my bag. I just don't get it. You know, it's trying to time the market is. Well, to me, it's almost like gambling, because you don't really know, just to your point, when it's going to hit the ceiling and then when it's going to drop back down again. Like 2008 was one of those scenarios that nobody could really saw how bad it was going to be. But I imagine that asset that you're just talking about a second ago has gone back up now surpassed what you would have thought it would have been worth at this point, I would think, right?
Well, yeah, and I would have held on to it if I could, but you know, a lot of the properties in New York that I had owned previous to the one I'm in now, which I've had for a long time, were all co-ops. So there's all kinds of rules and regulations with a co-op, and a lot of times you either can't rent it, or there's a possibility that you won't be able to rent it in the future, depending on what happens with the board and the bylaws and a whole bunch of things like that. So in the past, I always sold those when I was moving until I got into the townhouse I'm in now. And this one, we actually had moved away for several years and were able to rent it out and have a nice cash flowing property and didn't have to worry about a co-op board and bylaws and all that kind of stuff.
Right. Yeah, it's kind of like HOA. Co-op's the same thing, right?
Yeah, it's kind of like an HOA, yeah.
Yeah. So, yeah, I tend to avoid HOAs as well when we're buying assets. I mean, all we buy is multifamily assets, but as far as HOA is concerned, I'm not a fan, just because, just like you said, to your point, there's always another group of individuals that are deciding the fate for the property that you happen to own. And it's not my bag. I don't like that. I like to be in full control of the asset that I actually own. Right?
Yeah, and I think in most cases the co-op boards are way more restrictive and intrusive than a traditional HOA.
Yes, it's even worse, right? If you're gonna find a way for it to be worse, that's the thing to do right there. That's right. It's so funny. So good. So I know that you started off in this business as an LP investor. So take us through a little bit about why you did that. What was the logic around jumping into your first deal as an LP, and what was going through your mind when you're trying to figure this out?
I moved to Florida at the very end of 2015, moved down to Miami with my wife. She got a amazing job opportunity completely out of the blue. And that's when I decided to leave, corporate America. I had been working in digital advertising and marketing, ever since that time I moved to Washington Heights. When we moved down there, I was just kind of burned out. I mean, I had worked at many, many different agencies, sort of working my way up that corporate ladder. It was great. I loved it, had a great time doing it, but it was a very demanding job. Took up a lot of time and a lot of energy. And I had a young child at the time. And when we moved to Miami, and then when we had another one, we were down there. But when I moved down there, I decided that I wanted to transition from doing the digital marketing stuff I had been doing and start making real estate a full-time job. I had been doing it as a hobby for 10 years. When I made that transition is when I started to find out I wanted to grow a business and build a business and scale something. And doing the single family stuff that I had been doing, fixing and flipping and things of that nature, just wasn't terribly scalable, at least from my perspective and the way that I wanted to build a business. And that's when I found out about real estate syndications. So when I started to learn about real estate syndications, that was a big aha type moment for me of, wow, this is a perfect niche, because I knew how to do what I was doing and I had been successful as a hobby, but I didn't really have like a large amount of capital. I had a good amount of capital for a person, like a regular guy, but there was no way I was buying $10 million apartment complexes. Like, that just was not in the cards for me to have millions and millions of dollars of capital ready to deploy. So syndication, which is when a bunch of investors pool their resources together to go ahead and get these otherwise unobtainable assets, right? So this was a way for me to actually do that. And I figured, as I was starting to learn the ropes and figure out how to do that as a general partner, that it probably made sense for me to do that as myself, as an investor, to see what it's like, to understand what it's like from an investor point of view. And I spent the next 2 years actually investing as a limited partner in deals, while simultaneously looking for the right deal that I felt good about to come in as a general partner. And so, for 2 years, I spent time investing with different operators and learning different ways that they communicated. Obviously, ones that did well, that I liked their communication style, I've continued to invest with. I mean, to this day, 2/3 of my portfolio are deals that I am a limited partner in. I also have, almost 4,000 units at this point that I'm a general partner on. But I continue to do the limited partner investing. I think it's really great. I can't be an expert in every market. Look, I love Cleveland. I'd love to get something in Cleveland, so maybe I'll talk with you about one of your deals, because I know I'm not an expert in the Cleveland market, right? I don't have those connections. I don't know what's going on the ground on a daily basis, and you do. So that's what I look for when I'm looking to invest with other general partners, but I feel that I can bring that expertise to my investor base as a general partner now. But investing as an LP was, I think, crucial to me being able to learn sort of what it's like, and also, like I said, the different communication style, the way that different sponsors treat their investors. And I learned a lot of things not to do. And I learned a lot of things that I was like, oh, I love that this person does that. And when I get my first deal, I'm going to do things that way because I liked it. And that was part of my whole learning experience.
It's listening very closely to what you're saying. First off, for many folks, when they first want to get into this game, investing as an LP is a great way to learn, and that's exactly what you did. But it's funny, when you said you invested with a handful of these different folks, you've reiterated communication several times. And It's worth highlighting because many people, I think anyway, where they fall flat is their communication just sucks. It's just terrible. The way they communicate, or lack thereof, or if there's a problem, and it's not always sunshine and rainbows in the real estate business. Someone says that, they're full of crap. It's not true. There's stuff that breaks all the time, stuff that goes wrong all the time. That's why you get good GPs that know what they're doing, so they stay on top of it and correct it, right? But the wrong way is to just stop communication with everybody and just go back into a hole and do whatever. So it's totally the wrong way to pursue that. But in your case, like you said, you were looking at or evaluating their ability to communicate. Would you say that was, or actually, I'll have you answer it. What would you say is the top three things? I imagine communication is going to be one of them, right?
Sure. The top three things that I look for in a sponsor. Yeah. I mean, I guess there's sort of two aspects to that, right? Because one aspect is sort of as I'm looking at a deal and I'm working with a new sponsor, what am I looking for? And then there's another thing is like, what am I looking for when I'm actually working with them to decide if I would work with them in the future? While I'm evaluating sponsors, the things that I want to know are, what is their track record? I really would like a warm referral. If you tell me, hey, I invested with so-and-so and they did a great job, then I want to invest with so-and-so, right? So that's really important to me. And then I think the communication style during that, the introductory stage, right? When you're getting to know somebody and when maybe they have a deal and they're presenting a deal, I have found to be sort of a telltale sign of what it's going to be like after you've invested in the deal. So if I'm trying to get information, if things are haphazard and not really well put together at the beginning when they're trying to get my money, it's not going to get any better. So,
that's right.
And then at the end, for communication is something that's important to me. It might not be important to other people. I have a friend who I've invested in his deals, and the communication is so bad that I will no longer invest in his deals, although I love him dearly, because I never know what's going on. And so then it almost, I feel like, and this is just like a personal thing, it almost eats into our friendship where it's like every time I see him, I'm like, all right, well, give me the update on what's going on with the deal, because you haven't sent out any communication. Why don't you just send out an email about it every, quarter, and I won't ask you about it anymore. But 8-9 months go by and I've given you a significant amount of money, and I'm like, well, what's going on with the money I gave you? I like to communicate on a monthly basis with my investors, with deals that I have that are going on, until we're about 12 to 24 months in. Once we've gotten to a point where we've really stabilized on the asset and things are going really smoothly and we're just doing distributions and everything's sort of status quo, I'll then cut back to a quarterly type of report, because there's not that much news. Once you've executed, we do value add, so the first 12 to 24 months, super busy, lots of improvements, we can send out pictures, we can send out updates, but once you get past that, there's kind of not much more going on once you have a stabilized asset and things are just going along. But I think, we report quarterly unless there's some bump in the road, right? And then we'll send out a communication. But I found that communication to be key. A lot of our investors are really happy that when there is an issue, we're proactively going out there and telling them about it. No one wants to be the person who hears, from a third party that something happened on a deal you've invested in, without you knowing it. So, yeah.
Well, when you say communication style too, what exactly do you mean by communication style? Are you talking about methodology? You're talking about how they communicated? Like, what exactly do you mean?
Yeah, I mean style. And so that for me is, if I'm talking with somebody, if I need to hear from them or get on the phone with them or have questions, and I feel as though I'm bothering them, that I'm annoying, that I'm a nuisance, like, I don't want to be involved in that. I like to be involved in deals where I have a sponsor who treats me as an equal, right? And helps me out. Maybe they know a little bit more than me, that's fine, right? But they don't treat me like I don't know what I'm talking about, right? Or that I'm, make me feel stupid or something like that. I mean, I learned stuff. I've been in this business for a while. I've done a lot. I still learn things every day, right? Just in life in general. I mean, I learn stuff from my 6-year-old daughter, right? Like she'll teach me something weird that I didn't know, right? So everyone can always be learning. And you don't have to treat people poorly from that. And I have been in experiences where there's been sponsors who just either seem too busy or, demeaning or things like that, which is like, I'm not interested in that.
Right. Are you doing video these days, or is it still like emails and stuff like that?
It's still mainly email. The cost to produce video. Look, I can shoot a video at a property with a iPhone. I don't know that is really necessarily a tremendous benefit for investors. Look, if I was doing some sort of project update and showing, especially like new construction, then maybe video I could understand. We do a lot of photos, but to actually do like a property tour with video doesn't seem worth the expense or I don't know that I'd be able to do it on as frequent as a basis. I think the investors really want to know on a monthly basis, hey, what's going on, and what are the bottom line numbers, and we'd rather focus our time and our effort on managing the property rather than making marketing materials.
Yes. Yeah, I mean, and we do a lot of the video stuff as a matter of course, just to put out the camera, talk about the deal, talk about an asset, whatever. We just put it up on social as a
that's
thing.
Cool.
Yeah, that's how we do it. But it's not like this is an investor document or whatever. It's let's talk about this asset over here. But yes, we still send out the PDF with all the financials and all that fun stuff, all the bills, all that, whatever, so that way there's a high degree of transparency, and I think that's important when someone who's investing in these deals gets to see all the stuff that goes into it. And we were talking about this earlier. It's like being a GP on these deals is not exactly easy. It's very, very tough. It's a full-time gig, so many people, they don't understand how much work goes into it. It's a lot of work. Of work. But something you also said worth highlighting is how you get into the deal is an indicator of how the deal is going to go. And that's a rule that I apply for everything that I do. So if I'm working with a new lender that I never worked with before, and they're just a pain in the butt to deal with, I'm going to be like, oh my God, this is going to be a nightmare for the next 12, 24 months, whatever it is. We're going to be stuck with these guys. And so far, I'm 100% correct. Usually if they're a pain to deal with and getting into the deal, they're a pain throughout the whole process until you get out. So something for y'all out there to be aware of that. So same thing goes with deal sponsors. Same thing goes with everything. It's kind of like if that's how they're going to be, it's going to be difficult. So good. So now you made the transition to the GP side. I imagine you had to go off and get systems, technology, platforms, all that fun stuff to do all this, right?
Yeah, a little bit.
And then when you put your deals together now, are you putting them together personally, or are you like, do other people find the deals and pull you into those types of deals? Like, how does that part work?
Well, it's a little bit of both. A lot of the deals are deals that I'm going out there and I'm finding. I have a few different partners that I tend to work with. And so if I have a deal, a lot of times they're too big for me to, do on my own. A lot of the time I will bring in one or two of my trusted other companies that I work with, and we'll partner together on deals. And sometimes they might find an asset and call me up and bring me in. So I find that multifamily really is a team sport. You got to be careful. You don't want too many people on that team. I've seen, times when there's like 12 sponsors on a deal, and I'm like, all right, I don't know who's calling the shots here, number one, but number two, I don't know if that's really SEC compliant. I don't know. But there's nothing wrong with having a couple partners in on a deal. And I find it allows me to keep my overhead low. I don't have a very large staff of people that I have to use to keep the lights on. So then I have very large fees that I pass on to my investors. A lot of the deals that I do are actually, the investors are like, well, this is pretty, good stuff in favor of the investor. And I'm like, well, yeah, because I don't have like a staff of 500 people that I have to pay for, and a big office, that I gotta pay for. So I find that to be helpful. But yeah, I'd say about 50% of the deals or so are deals that I've actually found through my relationships with brokers or property managers or other property owners. And then the other 50% maybe are scouted by another person. But I always get brought in like before we have a purchase and sale agreement, usually before we've even made the first offer. Sometimes they might be in the stages of about to put in an LOI and they'll bring me in. It just sort of depends on what's going on at that time. But I always want to have input on the deal and the purchase and sale agreement before that's actually signed. And then, I'm involved all the way through. When I used to work in the digital marketing world here in New York, I was on the project management side of things. I'm a PMI certified project management professional, which just means I'm really good at managing people and timelines and budgets. And so I'm very involved in the asset management of all the properties I'm involved in.
That's a very valuable skill, because there's a lot of folks out there that they're really good at finding deals, very good at getting the debt, very good at dealing with the brokers, very good at doing everything else. But when it comes to managing the asset itself, that's the tricky part, and you kind of need someone that has, to your point, that asset management, project management skill set to make sure that everything's hitting with the way it needs to hit, And I think I was on a podcast and I actually said, buying a deal is easy. It's simple. Running it for 10 years straight profitably is hard. That's hard. That's where the money is made, is not buying the asset. It's running the asset, fixing it, raising the rents, knowing when to raise the rents, knowing when to get rid of the bad tenants, making sure you bought the asset in the right place at the right time. There's a whole lot to it. It's not as easy as the gurus out there say it is. It never was.
That's true.
Yeah. So I know that in the green room we're talking a little bit about some of your preferred markets. So tell us a little bit about the markets that you're chasing down right now and why you chase those ones down.
Yeah, I tend to believe that you can be successful in almost any market that you choose. There are many intangibles that I look at when I'm looking at markets. But once you get into a market, it tends to get a lot easier there. So the markets that I've been in, I tend to stay in because of the relationships that I've been able to make and the inroads with brokers and property managers and things of that nature. So for me, those have been some of the primary markets in Texas. And also I have had a lot of properties in the Kansas City area, Kansas City, and also Lawrence, which is in Kansas. It's between Kansas City and Topeka. And so if you're really into basketball, college basketball, you might know the Jayhawks. They're based in Lawrence, Kansas. But other than that, you might not know. I didn't know about it until I was looking in the Kansas City market. And a lot of the brokers and property managers also have assets in Lawrence. That's how I found out about that market. But those are the markets I'm in, Dallas, Houston. We're starting to do some stuff in Austin now. So those are some markets that we're involved in.
And when you go into these markets, you're doubling down and you're buying in, then you're expanding in those markets, right? That's how you do it.
Yeah, I do have some people that I coach and how to do this in real estate, and one of the things that I talk about is market mastery, right? And so you can be the jack of all trades but the master of none, right? That's an old saying, and I really think that to be successful in this business, in such a competitive landscape that we have right now, you really need to understand a market in and out so that you can know where is that path of progress, where are things going, where are there the opportunities that maybe people who don't know the market can, there's people out there looking for a deal and they're looking, I'll talk with them and they're looking in like 20 different markets or even 5 different markets. And I'm like, okay, have you been to any of these markets? Well, no. I'm like, well, how do you even know? Like, sure, you're sort of underwriting based on some guesses that you have and maybe some third-party data of some sort, but like, how do you really know rent growth like on that specific area, like that specific submarket or that specific block is going to be what you're getting from like this overall market data. Now, look, it's good. You want to have that third-party data to substantiate the assumptions that you're making, but your own local market knowledge can far surpass what that is. You can know, oh yeah, they're saying rent growth is 3%, but it's really only going to be 2% in that area. Or, hey, maybe it's going to be 4% in this area, and here's why. Because this new thing is opening up here, this employer just added 500 jobs, and this new employer is coming in. That kind of stuff you're not going to know unless you really, really understand and really know a market, and that's why it's important to master a given market. Yeah, and that's why, you're asking if I'm doubling down. Well, yeah, the more I know a market, the more I know all the players and the players know me, the more I can find opportunities. I get off-market deals. I'll get deals, not that they won't go on the market eventually, but a lot of times we'll get to look at a deal before it actually gets put out in the market. Because I'm already talking with the brokers. I happen to be talking with them. They have a new deal that's coming out in 3 weeks. They know about it because they've already got that deal signed with the seller. So they know they're going to sell this deal, and it's with their marketing department. And their marketing department is putting together the offering memorandum, and they're taking pictures. They're going to go and get a drone pictures and put together, make it look really nice in a nice glossy offering memorandum. Meanwhile, I tell them, well, just send me the rent roll and the T12 and let me take a look at it, and I can get an offer in before that offering memorandum is even done. And if I know I'm putting in a strong offer, and if it's right around what the seller's expectations are, there's no advantage for the seller to sit around and wait for an offering memorandum to go out and wait for the whole process, which could be several months, because by that point I've probably moved on to another deal and I'm no longer a buyer, right? So if I can put in an offer, a strong offer, a fair offer, but I can put it in right away and say, hey, here's my offer, and it's good for the next 72 hours or something like that, and then I'm moving on. And then the seller can make a decision if they think it makes sense or not. And a lot of times, we end up getting deals that way.
Yeah, well, I have a saying, it's good when you know the market, it's better when the market knows you. And that's exactly what you just described. It's phenomenal just to that point. I've had so many deals just come to me because the seller didn't want the whole dog and pony show and bothering tenants and bringing crowds of people through and all this fun stuff. Nobody wants to deal with that. They really don't. They want a nice, quiet, easy sale, right? And if you have a good reputation,
you don't want to disturb your property management company. There's so many reasons, and there's only, depending on the size of the asset, there's only certain groups that are actually going to be able to close on a deal.
Right. That's right.
So if it's somebody and you know that they can close on the deal, I mean, from a seller's perspective, right? If there's someone, maybe they're bidding a little bit less, but I know them. I know that they have other deals in the market. The broker's vouching for them, like everything. Like, why wouldn't I just go ahead and sell it with them? Then wait for that 2-month marketing period, and then let's say 30 days of due diligence, and then maybe another 30 to 60 days to actual closing, depending on how quickly the bank can move, right? So you're talking about 4, 5, 6 months here. And then if they can't perform, you're in trouble. The market could have drastically shifted. I mean, think about what's happened in the past 6 months just right now, right? There's been a huge change in the market. That could be millions of dollars that you're losing because you were trying to hold out for an extra couple $100K from this other group, Yeah.
Yep, that's right. That's right. I mean, it went from lenders giving away money to now they're worried about the next 6 months if they're going to be in business. It's really, really crazy how fast the market shifted in terms of what in a matter of 6-8 months. Banks are some banks are teetering right now. It's wild. It's just wild.
Yeah.
Crazy.
Yeah, a lot of lenders are pencils down, or have very different lending criteria. We're used to get 75 to 80% leverage. A lot of the deals we've done in the past, we're doing one now, and the last one we did, we closed in October. But both of those deals, our leverage was like 60% instead of 75 to 80. So from an investor perspective, it's actually a little bit safer to invest in something that has less leverage. But obviously, that's going to affect your returns.
That's right. That's right. So I know you sponsored your first deal was like $10 million, right? Is that right?
That's right. Yeah.
So tell me a little bit about that. How'd you get into that? Yeah, how'd you get into that one?
Yeah. Well, I was looking in the Kansas City market, and so a lot of people are like, "Well, you're from New York. Like, why was Kansas City even on your radar?" And it goes back to my acting days. I actually got a gig many moons ago, and that was in Kansas City, and I thought that I was going to be sitting around and watching corn grow. I mean, I was in my 20s, and I didn't know anything about Kansas City, and I just thought it was going to be like a really boring summer with like nothing to do. And I got to Kansas City and realized how completely wrong I was. It was a very, very metropolitan city. I had a blast. I had the time of my life. I mean, that summer was amazing, and I really learned a lot about sort of preconceived notions, I guess, and just really was like, man, I just so misjudged Kansas City, and I love Kansas City. So fast forward many years later, and one of my best friends ended up moving to the Kansas City area, and so I always had that soft spot in my soft spot in my heart for Kansas City, and so when he moved there, I decided to start looking in that market to see if there was anything that made sense from a real estate perspective. And I was looking at deals, and they were actually kind of penciling out, it looked like. So, on a very high superficial level, but it looked like the numbers kind of made sense. So I started looking in the area, started making trips to the market, getting to know all the players there, brokers, property managers, and eventually one of the deals that I looked at actually made sense. And I mean, I wrote, you mentioned earlier about my book that I wrote, and so I wrote a whole chapter in the book about this whole saga, but like I ended up getting this deal, so spoiler alert if you're reading that chapter, but like there was a whole bunch of ups and downs, but eventually we got that deal, and were able to close on it, and did very well on that deal.
And you said that, and that was the first one.
That was the first one. That was in Lawrence, Kansas. Yeah.
And the funny thing is that there's ups and downs. The first deal, no matter what it is, always has the most ups and downs and the most amount of crazy, wild swings, right?
I don't know. I'll tell you, I've been involved in some other deals since then. I've had a lot of ups and downs.
Well, that's true. That's right. That's right. It's sometimes it blows my mind that you're dealing with some sort of title agent, and you're expecting to see something, and it's totally incorrect. You're like, is this the first time you've done this? Like, how many times have you guys done this before? It's just like it blows my mind. It just blows my mind. It's crazy. But that's a good sized deal for the first one. That's for sure. That's great. Yeah,
it was 132 units, and it was a. I think there was good bones on that asset, but it just the ownership had the property for I think 12 years before we did, and they didn't touch a thing. So it just was in a really bad state of disrepair. So the Lawrence market is not like a high growth market at all. It's just a very slow and steady. It's kind of like the tortoise and the hare. It's definitely the tortoise, but this place had had rent so far below market because it was so neglected that when we were able to go in there and actually spend money and treat it well and treat it with the respect that it deserved, we did very, very well on that deal, and it looked really nice when we were done.
No, that's great. Yeah, finding those cherry deals is amazing, and so good. And are you still in that one right now?
No, we actually exited that deal. Our investors were super happy, and it was time to move on to the next one.
Excellent. Great. So, and I know that I heard about a $52 million deal, right? They recently did. We've done, that $10 million deal was probably the smallest deal. Yeah, I think that was the smallest multifamily deal that I did. The largest I did was $117 million. And I've sort of done everything in between. Usually right now around 40 to 50 million is around where we usually sit. Just depending. Sometimes we'll do smaller, sometimes we'll do larger. Right. Okay, good stuff. Well, excellent. So I know we covered a lot of stuff here today. If you had one piece of bulletproof advice for someone listening right now, maybe they want to get in as an LP. Maybe that's what they were thinking about doing. What sort of bulletproof advice would you offer them?
Yeah, I think we talked about it a little earlier, but it's about learning. It's about education. Always be learning. Look, if they're sitting here and they're listening to your podcast, they probably already know that, right? Because they're listening to your podcast, they're getting more educated. I think books, I think podcasts, I think, joining a local meetup or like a mentorship group or any of those mastermind things, like all of that stuff. I mean, you gotta be careful who you're taking your advice from, but I think learning, listening to podcasts, going on YouTube. I'm putting out tons of educational, like free videos on YouTube. Like there's a lot out there that you can consume and you can learn. And the more that you learn, the more informed you can be as an investor.
Yep. No, 100%. Totally agree. It's usually the difference is fear. Right, what stops people from taking action is that they don't understand it, and then because they don't understand it, they just stop dead in their tracks. But by learning and applying the knowledge, you're able to get over that fear and actually take action. Because that's the only time you're going to make any money in this business is by taking action. 100%.
Well, yeah, if you don't invest any money, you're not going to have any profits at all. But you got to be careful. You don't want to have those losses, but you can't let the fear of losses overtake the potential that you could have. And so, like you said, having that education, learning can help you get past that so you feel comfortable with what you're doing.
Yeah, love it. All right, guys. Well, if you want to reach out to Matt, you can reach him via his website at picheny.com. Hope you got a lot of information here about how to get into deals, especially if you're an LP and you're like on the fence, you're not really sure what you can do. Listen, getting in on the deal, learning from an experienced GP that knows what they're talking about, that you can study them, you can study the deal itself. Obviously, get on a good deal. You always want to get on a good deal, right? That's not exclusive here, but there's a lot of groups out there. Make sure you pick the right one. Do your due diligence on them too, okay? Thanks for tuning in, guys. See you next episode. Take care.
You've been listening to the Bulletproof Cash Flow Show. We hope you've enjoyed the show. We know we had fun. Make sure to visit our Apple Podcast page and leave us a 5-star review. We hope you've gotten some useful and practical information from the show. For real estate coaching, events, and resources, hit up bulletproofcashflow.com. Till next time.
No information in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this show are limited to accredited or sophisticated investors. Any investments will only be made with proper disclosure and subscription documentation and subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice.